What shaped markets today wasn't just price action, it was a fundamental shift in expectations around how the Federal Reserve will navigate a global supply shock. For the last 48 hours, the market feared the Fed would be handcuffed by rising oil prices. Today, investors began to bet the central bank will look right through them. After 2 days of heavy geopolitical selling, we saw a broad-based relief rally. The S&P 500 recovered nearly 0.75%, but the real story was in the Nasdaq, which surged over 1.5%. Fear premiums essentially evaporated as the VIX plunged 10%, erasing almost half of its recent spike. Interestingly, while equities rallied, crude oil continued to climb, gaining another 1.9% as the physical disruption in the Strait of Hormuz persists. Bitcoin also joined the risk-on move, surging over 7% to reclaim the $73,000 level. The primary driver today was a single, powerful shift in policy signaling. Federal Reserve Governor Stephen Miran indicated that despite the conflict in Iran, he still favors moving forward with rate cuts, by suggesting the labor market needs more support and that the Fed should look through the energy shock. He gave the market permission to decouple from the oil headline. On the corporate side, we are seeing a selective resilience. Apple saw massive institutional call buying, signaling confidence in the premium consumer despite macro headwinds. We also saw strong signals from the trade-down economy. Brosters surged after a significant earnings beat, proving that while consumers are deal-focused, they aren't stopping their spending entirely. However, the software sector remains a site of structural disruption. Companies like MongoDB and CrowdStrike continue to face selling pressure as investors aggressively reprice the risk of AI making legacy software models obsolete, a theme we're calling software Armageddon. Today's capital rotation was about renewed offense, but with a structural twist. Money flowed back into technology and consumer discretionary, specifically targeting companies with pricing power. Meanwhile, the defensive trades in energy and staples were abandoned as the need for a hedge diminished following the Fed's dovish comments. Beyond the US, the great rotation into emerging markets is accelerating. We saw record inflows into equity funds, suggesting that institutions are looking past US exceptionalism toward markets with more attractive valuations and higher growth forecasts. Investor psychology is now balancing three distinct bets: Fed dovishness, an M breakout, and a ruthless avoidance of software firms vulnerable to AI. Despite the rally, there are systemic vulnerabilities hiding in plain sight. Private credit liquidity is coming under pressure. We're seeing valuation drops in major funds due to their exposure to the struggling software sector. If redemption pressures force these funds to sell assets, it could trigger a broader liquidity crunch. Furthermore, the currency markets are showing signs of stress that equities are ignoring. The Indian rupee at a record low today as the oil shock continues to weigh on energy importers. The market's current strength is heavily dependent on these plumbing issues remaining stable. Today represents a short-term narrative adjustment within a much larger medium-term regime shift. While Governor Miran's comments reset rate expectations for the week, the underlying reality, higher oil, supply-driven inflation, and structural air disruption has not changed. The market has changed its interpretation of how the Fed will react to the crisis. But the crisis itself, including the closed Strait of Hormuz, remains intact. The next phase of market direction hinges on whether the hard data validates this new dovish optimism. All eyes are on Friday's jobs report. A hot print with wage inflation would immediately challenge the Fed's ability to look through inflation, potentially reversing today's gains. We are also watching for earnings from Oracle and Adobe next week. These will be the ultimate tests for whether the software Armageddon sell-off is an overreaction or a permanent repricing of the sector. Strategic takeaway for investors today was a Fed-driven relief rally, not a resolution of the underlying supply shock. What this suggests for investors is to position for a central bank that is willing to cut through turbulence. But to remain cautious, dovish policy is not the same as a benign environment, and the transmission risks of the oil shock are still moving through the system.